Hello and welcome back, guys. So today what we'll be doing is that we'll be doing this particular question called Kodiak, right? And let's see the requirement first. So it's under mergers and acquisition, yeah. Required a prepare a 3-year cash flow forecast for the business on the basis described above, highlighting free cash flow to equity (FCFE) in each year. 13 marks, right? Major chunk of it. Estimate again, right? Estimate the value of the business based upon the expected free cash flow to equity and a terminal value based upon a sustained growth rate of 3%. Okay, so terminal value, value of the business based upon expected free cash flow. Advise the directors on the assumption and uncertainties within your valuation. There is always uncertainties, right? 6 marks. Let's try and grab what do we need over here? Free cash flow to equity, right? Free cash flow to equity, and then free cash flow to equity, value of the business upon free cash flow to equity, and terminal value as well. And we also need to think about assumptions and uncertainties within the valuation. Okay. Yeah, so Kodiak is a small software design business established 4 years ago. Okay, owned by 3 directors who have relied upon external accounting services in the past. The company has grown quickly, and then directors have appointed you as a financial consultant. If you were to write a report, you would have to write financial consultant, right? To advise on the value of the business under their ownership. So we have to advise on the value of the business under their ownership. The directors have limited liability, and the bank loan is secured against general assets of the business. Directors have no outstanding guarantees on the company's debt, right? Outstanding guarantees is not there on the company's debt. And the company's SOPL and extracted SOFP are as follows, right? So revenue is given 5,000, cost of sales 3,000, 2,000, other operating cost 1,877, operating profit, and then you have the interest on the loan, right? And then PBT is there, income is there, income tax expenses there, right? Profit is 34. Okay, we've got the SOFP. Opening non-current assets is 1,200. There was some addition, so gross was this much, accumulated depreciation was that much, net book value is this much, right? So you add what else? You've got non-current assets, and then you've got the loan 990, right? And then net assets employed is this much. So that is basically in net current assets 899 plus 270. Oh, what am I getting? 270 plus 899. 1169 minus 990, right? 179, right? And then after that, software design company, small software design business. Current year depreciation is charged 10% on the year end non-current assets before accumulated depreciation. Okay, non-current assets, and then is included in other operating cost in SOFP. Okay, in other operating costs, right? And then what is this? SOFP for the latest. This is latest. Investment in net working capital is expected to increase in line. Expected to increase in line with the growth in gross profit. Growth in gross profit. Growth in gross profit. Working capital, right? Working capital. Right. Non-current assets. Other operating costs consists of variable component of 15% of sales, fixed cost 1,000, depreciation on non-current assets 127. Remember, there was 126 times 10%, you are getting 127, right? 10% out of this. And then 1,000 plus 750 plus 127. So we are getting 1877. That's how. Okay, so that's why we've been given that. Okay, revenue and variable costs are expected to grow at 9% per annum. Fixed cost is estimated to grow at 6% per annum. Okay, company pays interest on the outstanding loan of 7.5% per annum and incurs tax on its profit at 30% payable in the following year. Payable in the following year, not this year. Does not pay dividends. Okay, so that's this is the tax liability for the last year then. I mean, this is the thing, but it's not payable currently, immediately, right? It's not payable immediately. And then what I wanted to see was the 990 loan times, what's the interest amount? Pays interest of 7.5%, right? So it's 74, okay. And then the net current assets reported in SOFP contain 50,000 of cash, okay. It contains 50,000 of cash. So there could be inventory and other things, right? One of your first tasks is to prepare for the director of forward cash flow projection for 3 years and to value the firm on the basis of its free cash flow to equity. Okay. Prepare cash flow projection for 3 years. In discussion with them, you note the following. The company will not dispose of any of its NCA but will increase the investment in new current assets by 20% per annum. Right. The company's depreciation policy matches the currently available tax allowable depreciation. Straight line write-off policy is not likely to change. Okay, straight line write-off policy is not likely to change. The directors will not take dividend for the next 3 years but will then review the position taking into account the company's sustainable cash flow at the time. The level of the loan will be maintained at 990. On the basis of the forward yield curve, interest rates are not expected to change. The directors have set a target of return on their equity of 10% per annum, which they believe fairly represents the opportunity cost of their invested funds. So 3-year cash flow forecast for the business on the basis that described, highlighting the free cash flow to equity. Okay, we have to forecast it, right? Forecast the free cash flow to equity. Revenue is expected to grow at what? 9%. Let's see. Business valuation is commonly tested. This thing is not zooming in properly, but yeah. The business valuation is commonly tested, especially using discounted cash flow method. Be careful to lay out your workings carefully with a lot of forecast figures to derive. It is easy to get in muddle. A neat columnar format with reference to detailed working will ensure you'll score well. Given the details supplied, the forward cash forecast of the SOPL and SOFP is a precursor to did they say SO cash flow forecast for the business, highlighting that, right? And finally is a precursor to cash flow forecast on the assumption as stated in the question but not reproduced here. The following projection is obtained, all figures in thousands, right? So the revenue is 5,000, right? And then in the year 1 it's going to grow by 9%. So 5,000 into 1.0954 this thing, right? And then you just grow it by again 1.09, right? So yeah, basically cost of sales, what does it say? Cost of sales is 15% of sales, right? 15% of sales. Okay, that was for variable cost. There was something about fixed cost is expected to grow and variable cost is expected to grow at 9%. Okay, so cost of sales is also going to grow at 9%, right? So it's a consistent growth rate with that. A gross profit is growing at 9%. That just means that, right, it's growing at 9% because 2180 into 9%, I mean 2180 into 1.09, you will get 237677. Yeah, right, because if both of them are growing at 7%, your gross profit will automatically grow at 7%. And another thing that I wanted to see about was this operating cost, right? In that we need to do some working. So working note 1, workings, right? In working note 1, the operating cost variable cost component is basically 15%. So we have to do the variable cost, which is going to grow by 9%, right? Variable cost, remember where did they say variable cost is going to grow at 9%? So 750 times 1.09, so 818. Fixed cost is going to grow at 6%. And for depreciation we need to do another working, but depreciation is normally 10%, right? And we need to do some addition on that as well. So basically in the first year our non-current assets was how much? 1266, and asset was basically accumulated at that, and then that in the first year it was 1266, and then additions was what was it about to grow with? How much shall we grow it with? 20% per annum, right? Will increase its investment in new current assets by 20% per annum. So 1266 into 0.2, mm 1266 additions, right? Will not dispose of any of its non-current assets, but will increase depreciation policy as a straight line method, right? Were there any additions in that period? Additions, yeah, there was, so it's right over here, remember? 66 into 1.2, so 79.2, right? So we've added this much, so these are going to grow by 20% per annum, right? And then our non-current assets is basically 1345 at the period, and then we just add in the depreciation. So depreciation is going to be 1345 into 10%, okay? So 134.5, okay? So all these things, you get your depreciation, you put in that value over here, and then you get your total operating cost. So bring that value up to your operating costs, you get your operating cost, and then you put in your value, and then we subtract it, and then we get our operating profit. And now we should also look for, that's the value, right? And then after that we need to calculate what? We need to calculate free cash flow to equity, right? Free cash flow to equity in each year, right? So now what do we do in the thing? Because we the depreciation is not a cash outflow, so we add it back. We added that back, and then we need some working capital as well, isn't it? There was something about working capital. Loan will be same. There was something about working capital, isn't it? Where was that? Working capital, investment in net working capital is going to grow in line with gross profit. So it's going to grow in line with gross profit. What is it right now? Do they say anything? No, right? Working 3. So working capital is basically 240. So it is 240, right? What is it right now? It's basically, you see how they have got this figure 240 is 270 minus that 50, minus 50. 270 minus 50, right? So that's the working capital. Net current assets minus less cash, right? Initial working capital. Alternatively, the full 270 can be assumed as working capital as well. Credit will be given for either assumption. Okay, so 240, and then it's just going to grow by 9%, right? And then basically we get the incremental working capital 21 24, right? 2021 24. Taxation is how much? Taxation is 30%, isn't it? Somewhere I saw it. 30%. 30%. So it's going to be, we need to do some working for that as well, right? So it's going to be in arrear. So 15 is given, right? 15 is given already, and then that's going to be paid next year, right? So that's why 15 is already given. And then in the next year, what are we going to do? What's our profit in the next year? It's going to be 168 minus our interest, right? And then we get 168 minus 74, we get 94 times 0.3, we get 28.2, right? So this is the interest. But you see, this is not, this is, we are paying in year 1, year 2, year 3, but this was the tax for last year. Okay, you mean this year, the latest financial year, but we are paying it in 1 year delay. That's why you see it does not pay the dividends and incurs tax on its profits. Where is that? Payable in the following year. That's why we are doing that. Okay, in the second year, in this year as well, remember we are taking the figures from second year. 218 minus 74, 218 minus 74 times 0.3, you get 43.2. 43.2, right? So 43, you see, 43, right? So and then after that, what do? You subtract the interest from it as well, right? Because you're doing free cash flow to equity method, right? Because you don't want, what do you don't want? You don't want the debt value of it, right? You want the value of the company just for the equity holders only, not for the debt holders, right? And then we need we get all this figure. We also need to calculate the less investments in non-current assets, right? That don't forget, because we calculated that in working note 2. Remember, investments was additions. Investments was these additions, right? 79, 95, 114. So free cash flow to equity is 144, 114, 144, 173. So that is done, right? Yeah, that is done. It's easy to miss, like in an exam situation. Like, I mean, it's very easy to make mistakes, very easy to make mistakes. If you have not understood anything, do let me know. I'll definitely help you out around this thing. Not a big thing, right? So yeah, they won't give you anything straightforward, right? So I'll remember, in the working capital you had to compute it, and then what else? This addition part also, you might people might make mistakes over here, right? And then you will need that depreciation figure to be included in the operating cost, and working capital should be you done that way. And then this payable in arrear, right? Taxation part, right? Yeah. And then what else? Estimate the value of the business upon expected free cash flow to equity and terminal value, right? Based on this. based on sustainable growth rate of 3%, right? Terminal value and then the business value as well. So our estimate of the value of the business is a going concern assumes that cash will be generated and reinvestment made according to the above projection. The free cash flow after reinvestment, which is potentially distributable, and terminal value of the business assuming a constant rate of 3% forward, right? So we need to we have the free cash flow after reinvestment, right? And then remember, after 3 years it's going to be there is going to be a terminal value, right? So terminal value is basically, how can you compute that? You can just use the DVM model, right? So basically FCFE times 1 plus Z divided by KE minus your Z, right? KE minus your Z. So your free cash flow after year 3, right? Isn't it? Sustainable growth. Yeah. So we can use the same discounting factor, right, at 10%. So basically what you do, you have your FCFE 173, right? And then we multiply it with 1 plus growth rate is 3%, and then your cost of equity is 10%. Where do they say it? They say it somewhere. Remember where they told us? Depreciation is 10%. Where do they say that? They told I think the directors, they were expecting, yeah, directors set a 10% target rate of return on their equity, right? So 10% minus 3, we will get a terminal value of 2546. So we add in that value, and then the required rate of return is 10%. So present value of this will be this much, right? Discounting at 10%, and then the total value, adding all this up, the value of the firm will be this much, 2266 in 1000, right? So it's 2.266 million, right? So that's it, right? Estimation only, and terminal value, that's it. Basically you get 6 marks again, so 18 marks for calculation, right? Basically, so you could use NPV function as well to save time. If you don't understand this, do let me know. Do comment down below. I'll definitely help you out, okay? If you don't understand, advise the directors on the assumptions and uncertainties within your valuation. Assumptions and uncertainties, there is a lot of assumptions that we made, right? So lot of assumptions. Remember, the valuation is based on a number of assumptions which you should consider when reviewing this analysis. We have taken the judgment that 10% fairly reflects the market rate of return required for the investment of this type. This rate should compensate you for the business risks to which your firm is exposed. For an investment held within the context of widely diversified portfolio, the rate of return you should expect will be conditioned by your exposure to market risks, right? It will be conditioned by your risks, exposure to market risks. However, in context of sole equity investment, then the rate of return you may require could be more than which would be available for the market for an investment of this type. Why would you say that? Why did they say that? Because you are a sole equity investment, right? So that means in your diversified portfolio, you might not have like well diversified investments, right? So since you are only investing in one thing, you will require a higher rate of return, okay? And then, yeah, it's just more risks to you, right? In general. In generating our projection, we have assumed that estimates are certain and the firm is a going concern, right? And in considering the investments further, you may wish to explicitly consider the variability attaching to the underlying variables, right, in the projection, and possible ranges of value that may result. Ranges of value, right? It could be ranges of value because of underlying variables in the projection that we've used, right? And then the variability attaching to these variables could basically give us a range of value. So valuation is not always a exact number thing. It's a range. You will require a range for it, right? You will get a range based on your assumption. So one of the particular importance is that the assumption of 3-year forecast, right? In particular, the period chosen also depends upon the nature of the business and in particular uncertainties to which it is exposed, right? So we have also assumed the terminal value based on free cash flow from year 3 forward at a compounding rate of 3% into indefinite future. The resulting value will be particularly sensitive to this figure, right? Because you are taking it over a long period of time. So it may be that you may wish to consider a different rate depending on what you regard as sustainable long-term value in the business, right? So even the compounding rate of 3% will have a lot of influence, right? Because you're calculating a large chunk of it, right? A large chunk of it. You see the 2546 is being, you're considering that value is very greater, right? So that is influencing your overall valuation a lot, right? So the 3% is playing a big role because you're taking it over a long period of time, right? So as the time horizon increases as well, right? Not the time horizon, like it's indefinite, of course, but you see like the rate, even like 0.5 will make a lot of difference, even a 0.5 difference makes a lot of difference in like whenever you're using this kind of rate, like whenever you're calculating a terminal value. That's what I wanted to tell. And then it's always good to write this thing, yeah, in exams as well. Variability attaching to the underlying variables, and then the possible range of values may result. Okay, this is always a good generic statement. That's what I like to call it. All right. Right. And then yeah, it's not always subject to, you see, like the assumptions that we are making as well. You see, where is that yeah, you see the depreciation, you might not always have the cash to add 20%, right? So it might not grow at 20% at later stage when you've accumulated a lot of assets. You might not need, so like where the wear and tear could not be there. Maybe they are a software design company, you won't need to spend so much money every time, right? Every year you won't be buying a machine, computers or whatever, right? So you might be buying in 2 years time. So that's what they are trying to say in another words, all these stories that I'm trying to tell you, they are just trying to tell that, like a variability attaching to the underlying variables. What are the variables? All these variables, right? The depreciation, all these variables, right? In these projections, all these variables, like even the fixed cost, right? It might be less later on, like when people start moving to work from home approach and all as well, right? It might be different. Yeah, they later on they might not want all this taxation thing as well, like they might want to get rid of the debt, right? All these things could happen. So yeah, that's it for this particular question, right? So if you have any doubts regarding this question, do comment down below. I'll definitely be happy to help. And yeah, do like, share and subscribe this video. Take care. Bye bye. See you in the next video.